So imagine you just signed up multi-year billion-dollar partnership with, like, the undisputed king of the AI boom.
Right. The absolute dream scenario.
Yeah, you've secured the ultimate guaranteed buyer for your product. So logic dictates your company's value should just skyrocket. But instead, the market opens and your stock instantly plunges 10%. You literally get punished for securing a massive steady paycheck.
It's a phenomenal paradox, and it's actually happening right now on the trading floor.
It really is. If you are tuning into the 24/7 feed right now, you are in the right place. Welcome to NovaStream. I am your host, and today's mission is cutting through the noise to bring you the highlights of the day across live crypto markets, global financial indices, and the breaking news feed.
And we have a lot to cover today.
We really do.
Yeah.
Looking at the board for today, Monday, June 8th, 2026, we are staring at a day of just profound market contradictions. I mean, good news is tanking stocks, bad news is being totally ignored by corporate boards, and the traditional rules of, where to park your money safely are completely breaking down.
They're being rewritten in real time.
Exactly. Or, well, spot on. So let's unpack this, starting with the biggest numbers hitting the wire today. We are looking at the Elon Musk ecosystem, specifically the highly anticipated SpaceX IPO.
The numbers on this are just staggering.
Yeah, the proposed market valuation is $1.75 trillion, pricing in at $135 a share. I mean, looking at history, how do we even justify pricing a company that high right out of the gate?
Well, the justification relies almost entirely on a metric called the price-to-sales ratio, or PSR.
Okay, break that down for us.
Sure. So when you evaluate an initial public offering, looking at the traditional price-to-earnings ratio is often totally useless. Growth companies like SpaceX, they haven't booked substantial, consistent net earnings yet.
Right, because they're reinvesting every single dollar back into expansion.
Precisely. So analysts have to look at their total sales revenue compared to their total market value. And at $1.75 trillion, SpaceX's PSR is just astronomical.
No pun intended.
Right. But the historical precedent for companies debuting with a PSR that elevated is incredibly grim, honestly. Mathematically, to justify that starting price tag, they have to grow sales at a flawless, unprecedented rate for literally decades.
Wow. Decades of flawless growth.
Yeah. If they hit even a minor speed bump, the valuation collapses. That is why metrics suggest this IPO will struggle to even track the S&P 500 in the coming years.
It feels like pricing a ticket to Mars when the rocket is still just, drafted on a whiteboard.
Yeah.
But the scale of Musk's ambition connects to another major headline today.
The ASML conference.
Yeah. On the eve of this massive SpaceX IPO, Musk is stepping up as the keynote speaker at a private tech conference for ASML. He is openly calling them the greatest company in Europe.
And for those tracking the silicon space, ASML is basically the bottleneck for all advanced technology globally.
Right. They hold a functional monopoly on extreme ultraviolet or EUV lithography machines.
Yeah.
But why does a space CEO care so much about a Dutch tech company?
You have to look at the mechanics of microchips. EUV machines use light wavelengths that are incredibly close to X-rays to print microscopic complex patterns onto silicon wafers.
And nobody else in the world can build these machines at this scale, right?
Nobody. And Musk needs a literal mountain of this equipment for his Terafab project down in Texas. He wants to manufacture the hardware required for his AI ventures locally.
Which means his visions for space exploration and artificial intelligence all bottleneck at the physical manufacturing of advanced silicon.
Yep. It all comes down to the hardware.
And that hardware bottleneck perfectly explains the paradox we opened the show with. Let's look at the Asian markets today. Over on South Korea's Kospi Index, NVIDIA CEO Jensen Huang just finalized a massive partnership with SK Hynix
to co-develop next-generation high-bandwidth memory, or HBM, for AI accelerators.
Right. And HBM is critical because it stacks memory chips vertically, which allows AI processors to access data much faster than traditional memory. So SK Hynix locks in NVIDIA as a guaranteed buyer, and then their stock, along with Samsung Electronics, just falls off a cliff.
Down over 10%.
Right. Why?
Well, analysts are calling this the cooling AI trade. And the primary catalyst driving the sell-off is this concept known as locked-in pricing.
Okay, what does that mean in this context?
Over the last 6 months, expectations for SK Hynix and Samsung were priced to absolute perfection. I mean, they had essentially doubled the Kospi index. But these long-term agreements SK Hynix signed with NVIDIA severely limit their future pricing power.
Wait, so locking in a guaranteed buyer like NVIDIA is actually seen as a negative by the market because of a cap on potential profits?
That's the core of it, yeah.
That sounds like punishing someone for securing a steady, massive paycheck.
Yeah.
I look at that logic and it sounds like signing a long-term lease as a landlord right before property values in your neighborhood skyrocket. Yes, you have a guaranteed tenant, which is safe, but you've completely capped your upside.
That is the exact mechanism terrifying traders today. Jensen Huang openly stated that memory shortages are going to persist for several years.
Okay.
So traders realize that when SK Hynix finally scales up production to meet that intense global demand, they won't be able to charge a premium spot price.
Because they've already locked in their rates with NVIDIA.
You got it. You are trading future profit margins for current stability. Add in a broader global semiconductor sell-off due to weaker guidance from other chip players, and the market just decides to take a 10% haircut on these tech giants.
Man. So the back-end tech supply chain is facing a severe reality check on its future margins. But when you move from the silicon foundries to the consumer front lines, retail brands are dealing with their own boardroom dramas.
And the way they place blame is fascinating.
Totally. Let's look at Lululemon. Their stock just tumbled 10%, dragging them down 40% year-to-date. They slashed their full-year sales forecast to between $11 and $11.15 billion.
What really stands out here is management's radical transparency about their self-inflicted wounds. They are dealing with the massive fallout from the Get Low fabric line.
Yeah, that was a disaster.
When a premium athletic brand releases underperforming, overly sheer materials, it doesn't just cause immediate product returns, it fractures consumer trust.
And you combine that brand damage with fierce, agile competition from like Alo Yoga and Vori eating into their market share, and the revenue drop makes complete sense.
But the internal friction is what is really paralyzing them. They're currently locked in a proxy battle with their founder, Chip Wilson.
Right. And for those unfamiliar with the boardroom mechanics, a proxy battle is essentially a hostile campaign where outside shareholders, or in this case a disgruntled founder, try to persuade other shareholders to join their voting bloc.
To basically force changes in corporate leadership.
Yeah. Wilson is publicly stating the brand is losing its edge, which creates immense pressure on the current CEO, Heidi O'Neill.
It creates a complete state of paralysis. When leadership spends their time fighting for boardroom survival rather than focusing on product innovation, nimble competitors just sweep in.
Right.
Lululemon's is admitting their turnaround is going to take much longer than anticipated because they literally have to fix the leadership structure before they can fix the apparel.
It's a brutal internal reckoning. But here is the contrast I want to point out. It's fascinating how Lululemon admits to internal product missteps, while the rest of the S&P 500 points the finger at oil.
Oh, yeah. It is on almost every earnings call right now.
Right. Companies are blaming high oil prices driven by Middle East tensions for their tempered expectations. Yet a new FactSet analysis shows that out of the companies explicitly offering guidance, only 7 actually cut their profit outlooks because of fuel costs.
Only 7.
Is volatile energy cost just becoming a convenient buzzword to lower expectations on earnings calls, even when they aren't losing money on it?
The data strongly suggests it is. You really have to look at the difference between heavy industrial consumers and retail giants. Companies like Carnival Cruise Lines and United Airlines truly take the hit.
Because their profit margins are intrinsically linked to volatile jet and bunker fuel spot prices.
Right. But companies like Walmart and Target are remaining heavily insulated.
Because they just pass those logistical transportation costs directly to you, the consumer?
Spot on. They have diverse product margins and super resilient consumer demand. They complain about energy costs on the earnings call to build a psychological cushion with investors, but their bottom line remains virtually untouched by the pump price.
So it is basically expectation management disguised as economic hardship.
Pretty much.
Wow. So with high-flying tech dropping and consumer brands struggling, where is the smart money hiding to avoid the turbulence? We are tracking a major shift on the board today toward low volatility stocks.
Yeah, investors are prioritizing a smoother ride over raw growth right now. If you examine the S&P 500 Low Volatility Index or the MSCI USA Minimum Volatility Index, the historical performance is really compelling.
Let's hear the number.
From late 1990 to the end of May 2026, these indices produced annualized returns around 10.3 and 10.4%.
Okay, and the overall S&P 500 produced, what, 11.5%?
Right, so you give up a little return. But the crucial metric is the risk profile. Those low volatility indices were roughly 21% less volatile. You reduce your risk exposure by a fifth while only forfeiting about a tenth of your return.
It is the minivan of investing.
Right.
I mean, it's not flashy, but they get you there safely without the gut-wrenching swings.
That's a perfect analogy.
And if you look at the specific winning tickers driving these indices right now, you aren't seeing flash. You're seeing WEC Energy Group, Realty Income ticker symbol OPPL, Medtronic.
Yeah.
You're seeing General Mills, Kimberly-Clark, Abbott, Tyson Foods.
Snap-on and Roper Technologies, too.
Right. You are looking at utilities, real estate, groceries, and medical devices. These are structural necessities. You buy them because people pay their electric bills and buy cereal regardless of what the Kospi index is doing.
That underlying utility is what provides the stability. When macroeconomic analysts warn that the U.S. equity market is trading at historically overvalued multiples, the downside risk is elevated.
So capital naturally flows toward companies with inelastic demand.
Exactly. But speaking of traditional safety, the board is showing something highly counterintuitive today regarding gold.
Yeah, the traditional safe haven just suffered its worst sell-off since late March. It dropped 3%, slicing right through its 200-day moving average to sit at $4,443 an ounce.
Which is a major technical breakdown.
Right. For those tracking the charts, the 200-day moving average acts as a major psychological support line for traders. Breaking below it is a bearish signal. But here is what I don't get. The trigger for this massive gold sell-off was surprisingly strong U.S. employment data. Seeing a safe haven like gold drop precisely because the economy is doing well is a mind-bender.
It seems backwards, but it comes down to the opportunity cost of holding a non-yielding asset.
Meaning an asset that doesn't pay you just to hold it.
Right. When employment data comes in much stronger than expected, it signals a robust economy, which reignites market fears that the Federal Reserve will maintain or hike interest rates.
Okay, and when interest rates go up, the yields on government treasury bonds go up, and the U.S. dollar strengthens.
Spot on. And gold does not pay a dividend. It does not yield interest. So when an investor can get a strong, risk-free return by simply holding cash or government bonds, they dump their gold.
So it acts as a foil. It thrives on economic anxiety and suffers when traditional cash instruments offer a guaranteed return.
Correct. However, veteran strategist Ed Yardeni views this merely as a technical pullback. He doesn't see it as a structural collapse. He says there's a hard floor at $4,000 an ounce.
And his long-term outlook remains incredibly bullish.
Very. Because he believes systemic global geopolitical tensions will eventually override short-term interest rate fluctuations. He is projecting gold to hit $5,500 by the end of 2026 and a staggering $10,000 by 2030.
$10,000 by 2030. We will definitely see if geopolitical anxiety outweighs current bond yields. Let's pivot from protecting wealth in the markets to the ultimate financial equalizer: taxes.
Always a fun topic.
Right. First, a quick personal finance check regarding the IRS. If you filed an extension for your income taxes, the math of your delay is critical to understand. An extension delays your paperwork. It does not delay your payment.
That is a very common misconception.
Massive misconception.
Yeah.
The IRS assesses a failure to pay penalty of 0.5% per month, which caps out at 25% of your unpaid balance.
Yeah.
But they also add daily compounding interest on top of that penalty.
That compounding interest is what quietly destroys wealth. If you have an unpaid balance, you need to estimate and pay via the IRS portal immediately. An extension is not a pause button on your financial obligation.
Definitely. Now, looking at taxation on a more systemic level, there is a fascinating debate unfolding in California over a proposed billionaire tax on the upcoming November ballot.
And just a quick reminder for the listeners, NovaStream takes no sides here. We're just reporting the facts and tracking the mechanics.
Absolutely. Strict neutrality. The core proposal is a one-time 5% wealth levy on ultra-high net worth individuals.
And the debate centers heavily around mobility versus revenue. Critics of the measure call it a form of furniture burning.
Meaning what exactly?
Meaning you are burning the furniture to keep the house warm for one night. Because billionaire capital is highly mobile, experts argue this specific levy risks driving long-term earners out of the state, causing capital flight that could devastate California's long-term tax base.
Just for a short-term cash injection.
Right. But on the other side, proponents point to severe state revenue gaps that must be addressed, arguing that extreme wealth concentration requires a direct mechanism to tap into it.
And because of the fear of capital flight, public policy analysts are bringing alternative models to the table, right? Things like progressive, tiered corporate taxes, estate taxes, and federal wealth taxation.
Yeah, but the alternative that really highlights the modern mechanics of wealth is the proposal to tax loans against unsold stock as realized capital gains.
Okay, looking at this purely mechanically, is the concept of taxing loans against unsold stock, essentially an attempt to close a loophole where portfolios are used as collateral to generate tax-free cash.
That is precisely the mechanism they are targeting. It is colloquially known in financial circles as buy, borrow, die.
Break that down for us.
Under current tax law, if you own $1 billion in stock and you sell 10 million of it to buy a yacht, you trigger a capital gains tax on that sale.
Because you realized a profit.
Right. However, if you go to a bank, take out a $10 million loan to buy the yacht, and simply use your $1 billion in stock as collateral, that loan is not considered taxable income.
Because you haven't technically realized any gains. You still own the stock, but you have the cash in hand.
You get the cash, your stock continues to appreciate, and you pay no tax on that liquidity. By proposing a policy to treat those specific types of collateralized loans as realized capital gains, the state is looking for revenue gaps without assessing the static net worth.
It fundamentally alters how fiat wealth is recognized and taxed. But speaking of holding on to wealth in a shifting economy, let's move away from the regulated taxed world of fiat and step into the decentralized world of crypto assets.
Because right now, that ecosystem is bleeding.
It really is. Checking the live crypto board, Bitcoin is down to $62,000, and the pressure is severely mounting on MicroStrategy, specifically their preferred stock, ticker STRC.
Right. STRC is designed with a $100 par value to deliver a high yield of around 11.5% annually.
So it gives investors indirect exposure to Bitcoin, but with the structural yield of a preferred stock.
Exactly. But it just slipped below $95, closing at $94.65. Breaking below that $100 par value is a huge psychological blow, and it breaks a key psychological zone for stability.
And the primary pressure is sitting squarely on the shoulders of MicroStrategy's executive chairman, Michael Saylor. Looking at the on-chain data, he is holding 843,706 Bitcoin at an average cost of $75,701.
Which means he is currently sitting on an unrealized loss of over $11 billion.
$11 billion. Yet his response online this weekend was to literally post that it's a good time to add more dots, meaning he wants to buy more. At what point does a corporate strategy shift from high conviction to sunk cost fallacy in the eyes of Wall Street?
Well, that is the central debate dominating institutional forums right now. You have to understand that Saylor operates on a macro thesis regarding fiat debasement. He believes traditional currencies will inevitably lose their purchasing power.
So to him, short-term valuation drops are merely buying opportunities.
Right. But Wall Street risk analysts operate on quarterly reports, not decade-long timelines. An $11 billion drawdown is terrifying to them.
And MicroStrategy is not suffering alone here.
Not at all. Broader crypto market realized losses, meaning assets actually sold at a loss, just hit $174 billion since the peak.
Though, to put that in perspective, that is still below the $211 billion from the 22 to 23 bear market. So we might not have even hit the bottom yet.
We really might not have.
And we are seeing that structural weakness tear through major altcoins too. Look at XRP on the board. It just dropped to a 19-month low of $1.08. It is stabilizing right now around the 1.12 to 1.16 range. What is the actual path forward here?
The outlook is deeply polarized. The bear case focuses on XRP's structural utility constraints and macroeconomic fears like 3.2% inflation.
Right, because XRP is a bridge currency. If a bank uses it to move capital, they buy it, move it, and immediately convert it back to fiat.
Which creates constant mechanical downward pressure on the token's price. Technically, the chart shows fierce resistance at 1.28 and 1.88.
But on the other side, you have a bull case building in the background.
Yes. On-chain analytics show quiet institutional buying at these depressed levels. Plus, we are tracking the U.S. Clarity Act, making legislative progress, which provides massive regulatory tailwinds.
Add to that deeply oversold RSI indicators, showing the asset might be fundamentally undervalued right now.
Exactly. When the RSI shows a token is severely oversold, history suggests these rapid drops often precede multi-month recoveries.
So, briefly tying this all together, looking across the board today, whether it is AI memory chips, consumer retail, safe haven metals, or crypto, the traditional rules of what makes an asset safe or valuable are being completely rewritten right in front of us.
The market is demanding a complete recalibration.
It really is. And I want to leave you with a final provocative thought to mull over. We've seen wealth locked up in crypto waiting for a rebound. We've seen it parked in low volatility minivan stocks. And we've seen it used as collateral to navigate the tax code. As algorithmic trading and AI continue to reshape how violently markets react to a single jobs report or a new ship deal, will the concept of a true financial safe haven't even exist in 5 years? Or will everything just be subject to 2047 volatility?
That is the defining question for the next era of investing.
Truly, thank you for joining us for the highlights of the day. A warm goodbye to you as you navigate these markets. Remember, NovaStream is always on, streaming 24/7, tracking the live crypto markets, the S&P 500, and breaking news the second it happens. We will catch you on the next update. Keep your eyes on the board.